Good afternoon, good evening, good day, everybody, and welcome back. We've got some interesting markets again for you. I think realistically, we have to accept that they're not particularly easy due to volatility and a few other things. We have a world of problems, really. So it's clear that most of the major economies are facing a tough fight to contain inflation, and certain central banks are taking different stances to try and combat this. So inflation persists. Look at the chart here on the right. Consumer price gauges have exceeded estimates for a long time. Have we got a peak in place? Even if we have, are we going to go back to 2% inflation? Probably not for quite a long time. There's a lot of supply side issues still ongoing. And the Fed, through Powell particularly, has said the Fed will keep pushing until inflation comes down. Now we have the Fed minutes tonight, as I'm going to be online probably in about half an hour. So keep an eye on those. It'd be interesting to see if they want to send any clear, tougher messages there. But nearly all central banks, barring the Bank of Japan, are either hiking interest rates or about to. Now that obviously leaves the yen rather exposed as a weak currency. When everybody else is pushing, it makes yield differentials the play of the day, if you like. And that's why we've seen this ongoing yen weakness. But even that seems to be sort of turning around a little bit. But hikes ahead, look at this, economists' expectations. They even expect the ECB to raise borrowing costs in July, September and December. Will we get that? In reality, remains to be seen, but the markets are forward-looking and they are pricing that in. So there are two sides of the inflation problem. One is a good inflation side of things, which is consumer demand, which you can probably tweak with monetary policy. But then there's the supply issue. Now, unfortunately, the supply side dynamics do not allow the central banks to have a direct impact on that kind of inflation because they cannot produce more oil. They cannot make sure that wheat is readily available. They cannot make sure copper is pouring out of the mines due to demand. And so we've got this issue that we have a demand side, a supply side problem that we only have the tools to deal with the demand side of the issue, which is rather concerning. So that leads to a potential that as the central banks target the demand side, we see falling growth, but we still see inflation remain elevated. That is a problem. So if we look at confidence around the globe, US consumer confidence is in the basement. UK confidence, consumer confidence, terrible data. Even Canada, looking at consumer data there, we just picked this one out of the sky here to show you that even somewhere where the economy is relatively strong, consumer confidence is down. There's more talk of more hikes. So the central banks are actually attacking demand. Now that is a crucial thing to understand. The idea here is that they are tightening financial conditions, which means they are quite happy now to see stocks lower because it reduces the wealth effect. It tightens financial conditions. This is what they want to see. So to think the Fed is going to step in and suddenly start slashing rates because the stock market's off 20%, well, good luck with that, because that is not the messages we're getting from the Fed right now. That may happen at some point, but I don't think it's here. And they seem to be telling us that those levels are not here either. So the attempt to force consumers to feel less well off, where do you hit them? In their wallets. So their stock holdings come down in value. With inflation higher, they may stop buying so much. That hits the demand side of the equation. They can slow things down. Now, they believe they can get a soft landing out of this, not a recession. Well, we'll talk about that in a minute because it seems unlikely. But there are three clear scenarios for traders to be aware of going forwards. There is the soft landing. Now, the potential issues of that, a soft landing is obviously that they manage to raise rates to a level where growth comes down, doesn't go into recession, inflation is cured, and then they can stimulate the economy enough to get the economy back up again. The only time the Fed has really managed to do that was back in 1994, and that was because they were preemptive and ahead of the inflation they could see coming. The scenario now is very, very different. They are now in a situation where they are chasing inflation's problems. And that means the impact on demand and therefore growth could be a lot stronger. And therefore, the likelihood of recession created almost by the Fed and other central banks on tightening or squeezing the excess life out of the economy is probably going to be a scenario that we have to face. Are they prepared to take a shallow recession to get this job done against inflation? Yes, I think they are. And I think that equity investors need to understand what that means, because there is a danger or a risk to earnings on the back of this, as high inflation sees consumers buy less, but because there's a shortage of supply, retailers stock up on inventory but then can't sell it. And if they do sell it, it's a much reduced price. So their profit margins are reduced and therefore earnings are at risk. And I think we need to understand that sort of cycle of events that we're seeing. And I think a few have had almost a generation of buying the dip because they've seen this sort of supportive backdrop from the Fed to support markets. It doesn't seem to be there right now. Then we have the real bad one that I think a couple of economies, I don't think the US is looking at stagflation, but I think there is a danger that the UK may be. And this is a disaster scenario for central banks to sort of juggle this. Do I raise rates because of higher interest, because of higher inflation, or do I cut rates because I've got weak growth? What do? Is the chance of a policy mistake there? Yes, it is, very clearly. And I think the UK stands out quite clearly as one of the most vulnerable ones on the back of that. So when global growth goes down, that's bad enough. But in the UK, we could see an extension. We saw some very weak PMI data, particularly in services, falling at a very quick pace just this week, that suggests that growth is stalling quite quickly, and yet inflation is still elevated. And the Bank of England is probably going to have to continue to do something about that. And markets are pricing in another hike. How far they go with that is unclear, but we need more communication from them because the economy is looking very exposed. So central banks generally are on an inflation catch-up basis. And I think this is completely different to anything we've seen in the last 20 years. I mean, certainly since great financial crisis. If we look at global equities against central bank balance sheets, this is central banks doing QE. They have pumped money into the system. And you can see that global equities have rallied on literally the line that has gone on with expanding balance sheets at the major central banks. Central banks are starting to reverse that. So how can that not matter? So we need to sort of make ourselves aware of exactly what is going on with the news that comes out, maybe even tonight from the Fed, but other central banks, about adjusting or reducing the size of their balance sheets, because this is the drug that has actually taken equities to all-time highs. If that is being removed, then we need to be careful. Global economies right now, US is probably the strongest, or let's say the cleanest dirty shirt in the laundry, if you like. It is stronger than most and slightly protected against some of the issues. Commodities are priced in US dollars, and so the impact of rising commodities does not have the same impact. The US produces an awful lot of their own goods. They produce oil, they produce grains. Many other countries are not as fortunate. Japan imports just about everything. The EU is reliant on imports to quite a large degree. The UK, very much so. So commodity producing countries are probably going to perform better, and are. And there is a realistic suggestion that commodities could continue to see very strong demand, particularly if we're going to see climate control issues and onshoring of energy requirements in the EU, for instance, to combat what's going on in Russia. So, EU and UK walking that stagflation tightrope. But we need to watch what's going on in bond markets. Now, we saw this big run up in US yields that took dollar-yen up, took the dollar up generally, and it started to impact against equity markets, particularly tech stocks. And so what we've seen is this idea that the Fed will keep pushing until inflation comes down. This is the clear statement we're getting from the Fed. So therefore, stocks and earnings and growth fears are starting to impact. And we're seeing that in everything that we see on the charts and everything in the markets. So looking forward with timing being an issue now. Right now, scenario 2, the recession outlook looks more likely than most, apart from maybe in the UK where stagflation still remains quite a big risk. Look at earnings though. I think, if consumers are not willing to pay up and inventories are still building because companies are worried about supply, then there is a danger that margins, equity margins, corporate margins start to collapse. Now, we've seen this with Target and Walmart. Retailers are in a bit of a bad way here. They don't know whether to buy a lot of goods in because of demand, or if they bought them in and the demand dies at the same time, they're left holding the baby, basically. And there's a real danger here that they could actually have to start discounting very quickly. Now, we could have a peak in inflation on the back of that. Good news for consumers, good news for stock markets possibly, but bad news for corporate earnings, and therefore not so good news for stock markets. So earnings are something we need to keep very close eye on going forward. What this means for markets is probably continued volatility. From volatility, we get a reduction in liquidity, which feeds back nastily in a loop back to higher volatility. Dangerous markets. They are open to low liquidity, big moves, particularly around events like maybe even the Fed minutes tonight. Certainly data is becoming more important. And I think many central banks, literally, to get inflation back in the bottle, would take a shallow recession to get the job done. And I think we need to bear that in mind going forward.